Every market shock begins the same way. Not with bad earnings, not with inflation, not even with recession. It begins with uncertainty. And when uncertainty hits powerful institutions, markets don't crash because of facts. They crash because confidence disappears. Right now, newly released documents connected to Jeffrey Epstein aren't just scandal news. They represent something far more dangerous for global markets, a potential confidence shock to the US financial system and to investor portfolios worldwide. Because on Wall Street, perception moves faster than proof. Here's what most investors don't understand. Whenever powerful financial names come under scrutiny, investors don't ask moral questions first. They ask financial ones. Could lawsuits expand? Could banks face penalties? Could regulators step in? Could reputations collapse? If the answer to any of those questions is even maybe, money starts moving. Not millions, billions, moving silently before headlines even begin. Over 70% of daily stock market volume comes from institutions, not retail investors. And when institutions sense risk, they don't wait. They reposition. Markets don't wait for court results. They price in uncertainty immediately. And that's why scandals tied to powerful financial networks can trigger sudden volatility across US stocks, especially in banking and private equity. Because in global markets, risk is priced before facts are confirmed. Inside major banks and hedge funds, risk teams monitor legal and political signals around the clock. The moment a high-profile investigation gains traction, they start scenario planning instantly. Could this impact major institutions? Could fines hit earnings? Could regulation tighten? Could investor trust weaken? If perceived risk rises even slightly, they reposition quietly, reducing exposure to financial stocks, increasing cash reserves, hedging against volatility, rotating into defensive sectors. This doesn't happen on television, it doesn't happen in press releases, it happens in silence. And by the time news reaches retail investors, the smart money has already moved. Here's what most people miss. Banks don't run only on capital, they run on a single invisible asset: trust. Confidence from clients, confidence from investors, confidence from regulators. The moment that trust comes into question, everything slows down. Compliance costs rise, deal-making stalls, share prices drift lower, investor patience disappears. Major institutions like JP Chase have already faced scrutiny in past Epstein-related cases. So if new document releases trigger renewed legal attention, markets won't wait for a verdict. They'll price in the possibility the moment the story spreads. Because anticipation, not proof, is what moves markets. When institutional confidence weakens, the chain reaction is fast. Pension funds reduce risk. Hedge funds move toward cash. Global investors pull back from aggressive positions. Even strong indexes can dip suddenly, not because the economy is collapsing, but because the biggest players are temporarily stepping back. Markets don't need disaster to fall. They only need hesitation. And hesitation spreads quickly. Then comes the second wave. After institutions quietly reposition, media coverage hits the public like a shockwave. Breaking headlines everywhere. Market risk rising. Major names exposed. Financial uncertainty grows. Retail investors react emotionally. Some panic sell, some freeze completely, some move everything to cash, some fuel fear online. Short-term traders pile in, betting on volatility. This creates sharp downward pressure driven almost entirely by psychology. Not fundamentals, not earnings, not economic data, just fear. Historically, this phase burns out fast. But while it's happening, price swings are violent and unpredictable. So what should smart investors watch? Not headlines first. Watch regulators. Signals from the US Department of Justice, banking oversight bodies, and Washington will determine how long volatility lasts. If legal action expands, financial stocks stay under pressure. If it doesn't, markets stabilize quickly. And watch one more institution closely: the Federal Reserve. If the Fed signals liquidity and stability, confidence returns fast. But if uncertainty hits during high interest rates and slowing growth, volatility doesn't fade. It compounds. Because macro pressure amplifies scandal-driven fear. Every major scandal feels like the start of a crash. History shows, most aren't. Markets don't fall because information gets exposed. They fall because confidence temporarily disappears. And when clarity returns, its capital flows back in. Prices recover. Opportunities appear. The investors who win in these moments aren't the fastest, they're the calmest. Because on Wall Street, panic is expensive, but patience is where serious money gets made. New series alert! I'm sharing videos on how to grow and succeed. Subscribe now and stay updated with every new upload.